This bit on the capital asset pricing model is sponsored by Examinator Online, the platform to go to for SFC exam practice questions. Capital asset pricing model, CAPM for short, is often examined with numerical questions. This bit shows you how to perform the calculation. Now, what is the capital asset pricing model? It is a method of calculating the expected return on a share on an equity once you're given the risk-free rate of return, the risk-weighted market premium. Now, how do we get the risk-weighted market premium? We apply beta. Now, beta is a measure of the sensitivity of a company's return on equity to a change in the overall market return. So if the market went up 5% and your company's stock went up 5% or has done in the past, we would say the beta is 1. So the variability of the company's return is the same as the market as a whole. However, if the market was to go up 5% and the company you're considering goes up 10%, then we would say the beta is 2. Equally, if the market went up 5% and a company's return went up 2.5%, it's half of the market movement, then the beta would be 0.5. Now, how do we apply these concepts in calculating the expected return? Now, we use the expected return on an equity in share valuation. That's why it is an important concept. Do I need to know this formula for the exam? Yes. It is not complex. It may look complex, but if we break it down, it is straightforward. So R is the expected rate of return. That is what you're calculating. And we start off with the risk-free return. You expect at the very least the risk-free rate of return, which often will be government securities. To the risk-free rate, we're going to add what we refer to as the risk-weighted market premium. So the second term in this formula is the risk-weighted market premium. Now, the market premium is the return on the market return, minus the risk-free rate. So that gives us the market premium. And for it to be a risk-weighted market premium, we apply beta of the particular company. So I have the risk-free rate plus beta multiplied by the return of the market minus the risk-free rate of return. Now, a common question would be to give you the risk-free rate, the beta, the market return, and ask you for the expected rate of return. So let's look at such a question. The shares of Booker Industries have a beta of 0.85. So the returns of Booker are not as volatile as the market, and they don't move by as much. The share market is expected to return 10%, that's RM, and the risk-free rate of return, RF, is 3%. What is the expected return on the shares of Booker Industries? Now that's it. There's not much more to it than that. Although in an exam question, what they could do is give you extra information that is redundant. But we've, in this question, been given exactly what we need. So what is the expected rate of return R? It is the 3% plus the beta of 0.85 multiplied by the market premium, 10% minus 3%. That gives us 3% plus 5.95%. And so the answer is 8.95% for the risk-free return. And that's it. Capital asset pricing model has a lot of theoretical underpinnings to it, but that's not covered in the study material. It is the formula and the calculation that you are required to perform in the exam. So please remember that formula and do practice questions so that you can slot in the numbers so that it becomes second nature, and in the exam you can do the capital asset pricing model calculation very quickly. And of course, To practice those practice questions, go to examinator.online.